The Information Energy Administration sees global oil demand hitting a record high in 2023. I'm Sean Pruitt, president of Kingdom Exploration. I've got a lot of oil and gas news to go over. If you're interested in the oil and gas sector, relevant news to the oil and gas industry, this is the channel for you. Please subscribe. Right now, oil prices, WTI crude is $80.61, Brent crude $86.40. So we're well in our 80s, guys. And everyone was expecting, when I say everyone, I'm talking about the naysayers, the guys that truly believe that we're going to see demand destruction because of recession fears and everything else, and the weak China data and everything else. And here we are, over $80-something a barrel. Okay. And so the IEA sees global oil demand hitting a record high in 2023. Now, the Information Energy Administration, they always lean more towards the side of we're going to have plenty of global supply, and the demand is going to be much lower than expected. Well, they've changed all their numbers as China demand increases, and so it's not just talk anymore. We're actually seeing a demand in imports. We're seeing a demand in imports from Japan, from China, and India, and America as well. Okay, so we're going to be seeing an increase of imports. China's reopening is set to drive global oil demand to a record high of 101.7 million barrels per day this year, up by 1.9 million from 2022. So an increased demand of 1.9 million barrel a day demand. We've never reached over 100 million barrel a day demand for the first time in human history. The demand is going to be at 101.7, and OPEC is stating that we should be around 103. Okay. So the EIA is always much more conservative than most, and they're always having to retract and change their numbers, but they don't care. And it's already done the damage to the financials. This year could see oil demand rise by 1.9 million to reach 101.7, the highest ever, tightening the balances of Russian supply slows under the full impacts of sanctions. China will drive nearly half of this global demand growth, even as the shape and speed of its reopening remains uncertain. The IEA said Russia and China will be the two wildcards in the market this year, it added. Russian oil exports dropped by just 200,000 barrels a day in December despite the EU embargo and the G7 price cap. But the record price discounts on Russian benchmark export grades reduced Russian oil revenues by $3 billion to $12.6 billion last month, the lowest since February of 2021, the agency has estimated. I mean, they can't last Putin can't afford to keep losing money like this, okay? And so it would make more sense for him to reduce the supply, stop playing the games of the G7 price cap in the EU embargo, and to reduce the output to increase the oil price, making the value of his barrels even more valuable. So he's spending less money on export expenses as well as producing less oil while making the same kind of profits, because he's losing a lot of money right now. Oil is a precious commodity, and he could be saving that oil and sell it at a later date for a higher price. Okay. And I can't imagine him continuing under this environment, losing that kind of capital. The EU ban on Russian oil products from February 5th could soon mean that the well-supplied oil balance at the start of 2023 could quickly tighten. However, as Western sanctions impact Russian exports, the IEA's upbeat outlook on demand this year sent oil further rallying as prices extended Tuesday's gains into early trade on Wednesday. As of 6:15 a.m. Eastern time, WTI crude was up by 1.83% at 81.68. Brent crude topped the market at $87 per a barrel. Okay. And so every analyst, even the EIA, which is very conservative, is saying, hey, listen, demand is increasing and we're going to reach record highs for good reason. I mean, we hit 8 billion population and they need oil. Saudi Aramco is very optimistic about oil demand. Nasser reiterated the long-held view of Saudi Arabia and many analysts that the underinvestment in the industry in the past few years will come back to haunt the market. The world will need 4 to 6 million barrels a day of new supply just to offset the natural decline at the maturing oil fields globally. Nasser told Bloomberg spare capacity is just 2 million barrels per day currently, and it is likely to shrink as China reopens, he added. Aramco's upbeat outlook on global demand this year is also shared by OPEC and the International Energy Agency. Okay. So he's right. I mean, if we don't increase output, if we don't find new oil discoveries, we're not going to have enough oil. And in that event, oil prices are going to go up. You cannot continue at the growth rate without more oil. Okay. And somebody commented on my YouTube channel. He said, this peak oil stuff, we said it was going to happen several years ago and it never happened. Okay. And so if you look here, world annual oil production and peak oil. Okay. Now in 2005, now this is the production of 2005 and when it peaked, when it grew and when it peaked, and this is the production of 2010. So it separates 2005, 2010, and 2020. Okay. Now, if you look here at these, waves here, it shows when it grew and when it peaked. Okay. And so 2020, we peaked at about 2020, the year 2020. Now we're missing the data of actual growth and actual production, and it stopped at 2020. Now, if we had 2022 and 23 data, it would have dropped substantially. Okay. And so if you look here, actual production from 1900 all the way to 2020, you see a massive growth here. Okay. And so what happened was we peaked around 1980 something as far as conventional oil. All right. And so they were calling, hey, we all peaked, okay, peak production, and then we dropped, okay, and then they went offshore and they started making other major field oil discoveries, and so they grew all the way up to early 2000. Then we started running out of conventional oil, and they called for peak oil again. Then all of a sudden, we discovered shale. Shale oil and gas was responsible for 80 to 90% of the global oil growth. If shale was 80 to 90% of it, that means the rest of the world was responsible for 10 to 20% of it. That means while the rest of the world wasn't finding anything in comparison, shale was the biggest contributor to oil production growth. But the problem with shale oil, which is a non-conventional oil formation, it's a very fast decline. So what all the hundreds and hundreds of billions of dollars that we spent in these new oil field discoveries, and man, what should have taken 10 decades, we're able to get done in months because we fired up the printing presses and shell companies took on a massive amount of debt just to develop. Well, half of that is going to be lost in 12 months. Simply because of the fast decline rate of shale. Conventional oil might be a decline rate of 10%, as where shale is anywhere from 40 to upwards of 50%. So if we don't do anything, for every million barrel a day production, we're going to lose 450,000 barrels of oil a day. So we have to fire up the printing presses again, and we have to start developing. But the problem with shale is that the easy to get to oil is gone. And so now they have to spend more money, more capital, to get the same amount of oil as they did in the early stages of shale back in 2012, because the sweet spots have been taken, okay? So it's undercapitalized, and we're never going to fire up the printing presses like we did 2012 to 2019. And so if you look here, we have this we have this dip right here in the 80s because we were running out of conventional oil, and then we hit offshore oil in this area. And then shale hit, and all of a sudden we slammed up quickly, okay? Now, if you look at the annual growth here, this chart makes it a little simpler to understand, okay? Most of your world, and this accounts for world oil growth. This isn't just U.S., okay? Most of the growth was in the 1900s, and then you see a massive decline from the 1920s to the 50s, okay? And then you see a jump here in 2020. Okay, that's all because of shale from early 20 to 2020. That's all because of shale oil and gas. Okay, and so here's the thing: in the past, when we called for peak oil, it was we didn't have anything outside of conventional. Then we discovered offshore. We called for peak oil again. we didn't have anything. And then all of a sudden we discovered shale oil and gas. And now we're calling for peak oil again. We don't have anything else. In addition to that, we all thought the peak oil thing was BS. And then we all believed that green energy was going to take over. Now, all of a sudden, we're in a situation where oil has never been so tight and the demand's the highest it's ever been. We're in a 5-year underinvestment cycle because everyone believes that somehow, some way, we've always had oil. We always make these massive discoveries. And the global alarmists that are saying peak oil, they've gotten it wrong the last 2 times. This is no different. Guys, listen. OPEC doesn't just simply sound the alarm. There's very educated, smart people in OPEC that studies oil and gas. They are sounding the alarm bells. In the past, the guys that were sounding alarm bells, they weren't industry executives like OPEC, okay? The higher ups. And it was more, people weren't as much in agreement, okay? For the first time, there's many analysts, many people in OPEC, many people at high places in this business. They're in 100% agreement. There's no other place to go. Otherwise, Chevron would be tapping into these oil-bearing formations, British Petroleum and all these majors, okay? They simply went from conventional oil onshore to offshore. And then after they ran out of that, they started developing shale. Now they have nothing left. I mean, who develops, unless you're desperate, you don't want to develop in shale. It's the fastest declining asset. It's the most expensive barrel to ever produce. Okay. And so as you can see here, if things keep going, you're going to see this massive decline from 20 to 2040. I mean, it's such a huge decline. And it's unless we find something to fall back on, we're going to be in a mess. OPEC expands control of oil markets as shale growth stalls. After a decade of exponential growth, the U.S. shale patch is no longer the swing producer on the global markets. That role is now back in the hands of OPEC and its largest and most influential members in the Middle East. Analysts and industry executives say, from growth of over 1 million barrels per day in oil production annually before the pandemic hit demand in 2020, the United States is now set to see the growth rate at half of that at best this year. Okay, at best. Now, there's many market analysts, there's many people in this business that think that's impossible even at that. Because in order for you to increase, you have to simply add additional 450,000 barrels of oil a day to the market each year for every million barrels of oil to make up for that 45% decline rate. In addition to that, it's harder to produce a barrel of oil in shale today than it was in the days of 2012 to 2019. Number one, it was easier to get capital. And number two, they had higher production rates for every dollar they spent simply because they were in more premium fields. Now they're going from the first tier fields to the second tier, the lesser tiers. And so wells that they could drill for $10 million and get 1,000 barrels a day, now they're spending even more money for less oil, okay? Although the most of the growth comes and will come from the shale patch, the pace of output increases has slowed, and some analysts have recently called the peak of shale production coming as early as 2024. Okay, I think we're already there. A number of factors have combined in recent months to weigh on U.S. shale production growth, from capital discipline to labor shortages, from lack of external capital to cost inflation and high interest rates, from the exhausting prime locations to drill to steeper drops in well productivity over time. Okay. Now, they're right with exhausting prime locations. Okay. And so here's the thing you have to understand about oil and gas. When you tap into an oil reservoir, it's not the same every time. Okay. And so they have 3D seismic. 3D seismic gives them the ability to see what's happening under the ground by having this massive equipment sending vibrations and frequencies throughout the Earth's surface. And then all that data is put into a supercomputer. Then you have geophysicists that can analyze the data and have an understanding. And so they could find the structures, okay, the shell structures. They know where they are. And so what did they do? They went after the premium leases first. They went after the best locations first. And now they're going to the lesser locations. So they're exhausting prime locations, okay? And here's the thing. They're putting a lot of emphasis on capital discipline and labor shortages and lack of external capital, okay? And they're blaming inflations and high interest rates. Look, at the end of the day, if you invest $1 and you get back $3, aren't you going to want to invest even more? The shale industry is the most expensive barrel of oil to produce. And most of that production happened during the days of Trump when we averaged 50 something dollars a barrel. You need $70 to $80 a barrel to be profitable. So all the banks, all the lenders, they lost money. Even on the financial side, even on the stock market, people are afraid to dump their money in such a volatile market. They lost a tremendous amount of the capital that was invested in oil and gas on every level, especially in direct participation in shale drilling programs. I was one of the guys that lost money in 2004. I was in the Barnett Shale in Dallas, Texas. So bottom line, shale simply lost a lot of money, okay? And shale was the last option. We ran out of conventional oil. Now, when I say ran out of conventional, if you're a large company like Chevron or British Petroleum, there's just not, when you have hundreds of billions of dollars to spend, there's not enough conventional out there. You need a massive place. Shell, you could drill 1,000 wells and still have more shell. It's just a massive amount of it. It's everywhere. But the problem is it's so tight, it's very expensive to produce. Okay. And so the shell companies need to stop blaming everyone except for themselves. They are themselves to blame, but they did it out of desperation because they had no other place to really develop. I mean, if there was a tremendous amount of conventional oil and a tremendous amount of offshore oil, they'd be focusing in those areas versus shale. Okay, so U.S. shale will still grow even at low rates, analysts say, but the Permian will no longer be the global swing producer it used to be before 2020, when U.S. producers plowed all their cash and took on more debt to drill, baby, drill, every time oil prices moved higher. Last year, not even $100 oil tempted American producers. Supply chain bottlenecks, cost inflation, labor shortage, maturing asset bases, and lower available of capital have been the biggest drags on U.S. shale production over the past year, executives at E&P firms said. I mean, they're only saying that because they don't want their stock to drop. But at the end of the day, they got to blame themselves. They're not going to come out and be honest. Look, we just didn't make enough money, guys. At the end of the day, people are going to invest if you're making the money. A total of 32% of E&P executives selected cost inflation or supply chain bottlenecks as being the biggest drag on their firm's production. 27% chose maturing asset base, and 16% indicated availability of capital. Other options each received 9% or less. Okay. Geopolitical risk, economic uncertainty, material and or labor shortages, and administration that is hostile to the industry have made it difficult to project what the next 12 to 18 months will be like for the upstream sector. One executive at an E&P firm said in comments to the survey. According to the EIA's latest short-term energy outlook, U.S. crude oil production is expected to have averaged 11.7 million barrels a day in 2022 and will average 12.4 million barrels in 2023, which would surpass the record high set in 2019. Now, with that said, I seriously doubt we're going to see highs of 12.4 million, okay? But even if we do, the demand for oil is increasing, okay? So we really need to pump up those numbers. We're not going to be able to meet the demand that is coming, okay? This may be too optimistic. Some analysts and industry officials say, well, of course, I agree with them 100%. Conversely, the combination of modest U.S. supply growth of 0.4 million barrels a day, OPEC intervention, and Russian sanctions prevents critical OECD crude product and SPR inventory builds, leaving the market undersupplied if an anticipated pickup in the global economy materializes in the second half of 2023. Okay, so here's the deal. So last year, we were expecting Russian oil supply to be taken off the market. It didn't happen. China was in major lockdown because of COVID restrictions, and we had the Strategic Petroleum Reserve pumping out 300 million barrels of oil. And we still had a supply deficit. We still didn't have enough oil. What's going to happen as Russia's supply is, we've already lost 200,000 barrels of oil of Russian supply, and we're going to lose even more. Okay. Before we kept saying, hey, we're going to lose Russian supply, and it never happened. Okay. They found ways around it. Well, we actually lost 200,000. Okay. And then also we were saying China demand is going to skyrocket. Well, that didn't happen either. Well, now we're actually seeing their COVID restrictions were lifted, and now their demand is increasing. We're seeing a demand increase in India and Japan, in different parts of the world, even America. Okay, so now we don't have the strategic petroleum reserve to save us. We see the supply of shale declining, as far as new discoveries, as far as growth, as far as we don't have shale to save us anymore. So this year, the markets are going to be the tightest they've ever been, especially since we're going to hit demand levels that we've never experienced ever. Okay, and we have nothing to fall back on. Analysts at Energy Aspects warned in October 2022 that U.S. crude oil output from shale basins could peak in 2024. Okay, I think we've already peaked, but they could be right too. The aggressive growth era of U.S. shale is over. Scott Sheffield, CEO, the largest pure play shale producer, Pioneer Natural Resources, has recently told the Financial Times. The shale model definitely is no longer a swing producer, Sheffield noticed. Many companies are running out of inventory and are moving to Tier 2 and Tier 3 inventory, Sheffield added. Shale growth will probably be around 400,000 barrels this year, down from 500,000, 600,000 barrels Sheffield had predicted for the last 12 to 18 months. So many analysts and oilmen are lowering their predictions for shale oil output. And most of the headlines are coming from people that are in the business. So they have a biased view of their industry. And if they come out and say, hey, listen, shale production is going to decline, and you're basically saying, hey, our company has given up. We're not able to increase output. And that's where the capital is made. And so and people aren't going to invest in that. And so what you need to understand here, many companies are running out of inventory and are moving to Tier 2 and Tier 3 inventory. Okay. In other words, they've already developed all the Tier 1 and they've ran out of Tier 1 locations. So now, out of desperation, they're moving to the lesser shale fields. So it's going to cost more money to produce a barrel of oil than it was before. So you got to really think about it. You got to get this in your brain, okay? 90% of the world's global oil production growth was in the U.S., in the shale basin. We spent record amounts of money because we fired up the printing presses. Now we have this major global oil campaign that's anti-oil. The banks aren't funding oil and gas. They not only are being told not to invest in oil and gas because of the agenda, the anti-oil and gas agenda. In addition to that, the banks lost a lot of money during the shale glut. We were producing way too much shale oil. They spent too much money too quickly developing oil and gas, and the demand just wasn't there. And so they lost money, a tremendous amount of money. Okay. And so how in the world are we going to grow in U.S. shale and produce enough oil for the future record-breaking demand when they're not going to the banks are not going to capitalize shale anymore like they did in the days of old. In addition, it takes more dollars to produce a barrel of shale more than it did in 2012. It's more expensive now because they're in Tier 2 and Tier 3 sections. Do you see what I'm trying to say? There's no way. The only way we can do this, unless we spend twice as much money during the heydays of shale oil and gas, and that's never going to happen again, guys. It's a mess. So, and that will continue to decline over the next 5 years, Pioneer CEO said. Okay, OPEC is now in the driver's seat, and if oil stays around 75, the cartel will likely act to support prices, according to Sheffield. They need oil to be at $100 a barrel or higher, in my opinion. OPEC ministers are frustrated over the recent price fall. It's understood, I think, going to change. If it stays too low, it wouldn't surprise me if they had another oil cut. But they've got to wait until February 5th to watch the product ban on Russia, he said, at the Goldman Sachs conference, okay? And so the EU embargo oil products are going to be embargoed on Russia. And so everyone's waiting to see what happens and how that affects the global markets as far as oil and gas, okay? And so at the end of the day, in the event that this Russian oil embargo, February 5th, for oil and gas products, if it affects the oil supply, OPEC is going to intervene. So whether it's whether it decreases supply or it increases, OPEC is going to offset that, okay? And their goal is to keep oil prices in the high 80s to low hundreds. For Jeff Curry, global head of commodities at Goldman Sachs, U.S. shale patch was the place to look for spare capacity before 2020, and it was capable of influencing oil prices when American oil production surged in the decade of 2020. Today, the flexibility is gone, pushing us back to the old oil order of OPEC dominance, okay? And so OPEC is ultimately in control. I wanted to talk about windfall tax, but I don't want to make this video too long. But bottom line, windfall tax is hurting the oil and gas industry in Europe, and it's reducing the amount of oil development, okay? It's costing the oil companies billions and billions of dollars, okay, reducing the amount of development, okay? And I think America is to follow, okay? And so bottom line, we don't have shale to look at anymore. There was a time that we had plenty of conventional oil, and demand during the days of the 80s, it skyrocketed, and we were only at 85 million barrel a day demand in 2008, and we were running out of conventional oil. And so we found offshore, and offshore oil was able to meet that increased demand because we went from 85 million barrels a day up to 100 million barrel a day. And so then we discovered shale oil and gas. So we had conventional oil, we had offshore oil, and we had shale oil and gas to save us. Now demand continues to grow. We hit 8 billion people for the very first time, and we have nothing else to help us, nothing to save us. In addition to that, we have this anti-oil and gas agenda in the world with anti-oil, and it's shaming the banks, the SEC and the ESGs and the majors out there that administer the banking industry and the oil and gas industry is going to reduce the amount of capital for oil and gas development because they want to save the world, okay? Now, whether you believe that or not, that's neither here nor there. What you need to understand is that we are going to not have enough oil to meet with the global supply, okay? But everything, the analysts, and for the first time, the EIA is agreeing with OPEC, is agreeing with the analysts that, yeah, global oil demand is increasing, okay? And so I guess they finally got the memo from OPEC, or maybe they subscribed to my YouTube channel, I don't know. But anyways, all right, guys, I'm Sean Pruitt, president of Kingdom Exploration. If you like this channel, please subscribe. If you're interested in investing in oil and gas, please go down in my description below, click on the link, fill out the form. I'd love to chat with you. I look at a lot of oil deals. For instance, on LinkedIn, I've got over 5,000 people that follow me, and most of them are in the oil and gas industry. And they send me oil deals, and I've got a geologist that looks at them, okay? In the early days when I made my first oil investment in the early 90s, 94, it was harder to find oil. Nowadays, these oil companies are sending me oil deals on a silver platter because they're in desperate need of capital, because the fundamental way of getting capital, the traditional ways of getting capital are gone because these banks aren't funding them anymore, okay? And so they're handing over projects that we would have never been able to get involved with simply because they just need capital, okay? Otherwise, they'd be talking to a bank. I mean, you prove up a lease, you start developing oil and gas, you just go to a bank and get some capital. Well, now you can't do that anymore. It's not like it was before. Anyway, so now we've got amazing oil deals that normally I wouldn't have had. And so it make opening up the door for even greater success. And so if you have a great oil deal, send it to me. Go to my description below, fill out the form, give me a call, or get my email address. Send me the deal, send me the book, send me the specs on. I love send me logs, send me well logs, send me all the data you've got. I'll get over to my geologist, let them look at everything. All right, guys, pleasure. It's always a pleasure to chat with you. Please comment I love interacting with you guys. I appreciate the attaboys and everything else. All right, guys. Thanks.